Are you thinking about buying a home in Lancaster but not sure how much you need to put down? Guess what? It might be a little bit less than you think. In this video, we're going to take a look at the different types of loans, how much you may need to bring to the table on closing day. Also, a couple of little tips to help you get those closing costs down. So first of all, what is a down payment? A down payment is the initial investment into the property that shows the bank that you are going to be a reliable borrower. The more money you put down, the less risk you'll be deemed and the better interest rate that you will get typically. In a world where the cost of living seems to be getting higher and higher, it's not always easy to save up a huge down payment. So here are a couple of different loan options that can help you get into a home with less money down. Now, it's also worth mentioning that the higher the down payment, the less money you're going to have to pay on a monthly basis. Also, when you hit a certain threshold, it means you won't have to pay that pesky mortgage insurance. So first of all, we have FHA Financing. This is a program for first-time buyers. Technically, if you've not owned a home in the last 3 years, you can also qualify for this program. It's backed by the federal government, so you can get a lower interest rate with less money down. It's also open to people with lower credit scores than conventional financing. So for example, on a $250,000 home, your down payment is going to be 3.5% or $8,750. Now, this isn't the total amount you're going to have to bring to closing day, but if we start with the down payments and then we can talk about closing costs at the end. The pros to this type of loan are you can get a lower credit score going down as low as 620. Some lenders may even be able to go a little bit lower than that. It also allows you to go to a higher debt to income ratio. So it means you can borrow more money because a higher percentage of your overall income can be used towards housing. Now, the downside is you are going to have this MIP or mortgage insurance premium for the lifetime of the loan, which wouldn't be the case on a conventional financing. What is conventional financing, I hear you say? Conventional financing is a type of loan that many local banks and national banks offer, and it has far less restrictions on the types of home that it can be used to help purchase. It tends to fall into one of these three categories. The first time home buyer 3% down loan. This is for people who've not purchased or owned a home in the last 3 years, or someone who's never owned a home at all. The down payment amount is going to be slightly less than the FHA at $7,500 on a $250,000 purchase. Now, this time we don't have MIP, but we do have something called private mortgage insurance. This is going to be something that nearly all lenders will charge you on properties that you're not putting 20% down on. Now, I do work with some local banks who offer a conventional financing with no mortgage insurance, but you're going to have to speak to your own lender in your area. Now, the pros are you are going to be able to have a lower down payment, 3% compared to 3.5%. So on a $250,000 property, it's going to be $7,500. What's also great about conventional financing is that the appraisals are not as strict as FHA. This means they're much more attractive to sellers as you don't have to get things fixed prior to moving into a home. The cons are you are going to have a higher credit score to qualify for this particular type of loan, and the mortgage insurance is more expensive the lower your score is. Someone who has a credit score of 800 will have a lower PMI payment compared to someone who has a 680. You also won't be able to borrow as much money as they have more strict debt to income requirements. If you're not a first-time home buyer or potentially you're using someone as a cosign, a 5% conventional loan is going to be your next best bet. This means on a $250,000 loan, you have to bring $12,500 as your down payment. You are going to have that private mortgage insurance, which will fall off when you hit 20% equity. And it's a good option for buyers who don't qualify for that 3% or who've recently purchased a home. Next up, we have the 20% down payment option. So for a conventional loan where you're putting 20% down, you are going to be looking at $50,000 plus closing costs. However, you're not going to have to pay any mortgage insurance as you have that 20% equity. This is great for people who have a little bit more cash in the bank and want to keep their monthly payment down and avoid mortgage insurance. You also get a lower interest rate because the bank sees you as a lower risk. You can put more money than this down. However, these tend to be the main thresholds that we see with most buyers. Now, a bonus option is there is a local lender that I use. They offer a 0% down conventional mortgage with no mortgage insurance. The interest rate does tend to be a little bit higher, but it's a really great option of being attractive to the sellers by having conventional financing and a conventional appraisal. You don't have to put any money down for your down payment. You only have to pay for the closing costs. And you can even ask for a seller credit up to 3%, which means I've had people close on a home for as little as $2,500. There are also income limits for this type of product, and you do have to have a credit score of 680 or above. There's also 0% down options with the VA, so if you've served in any branch of the military, there are great products that can enable you to put 0% down and also help you save on some of those closing costs. And then finally, just wanted to quickly talk about seller help. If you're in a situation where you found a home, potentially it's been on the market for 15 days or more, you may be able to negotiate getting some seller concessions towards your closing costs. Typically, on a $250,000 loan, you're probably looking at the closing costs being around $10,000 to $15,000. Now, on an FHA loan, you can get up to 6% of the purchase price back as a credit towards your closing costs. Now, you have to remember, the more seller assist you ask for, the less attractive your offer is going to be, because the seller is going to net less money overall. On conventional financing, we can get somewhere between 3 all the way up to 9%. And this is going to depend on how much money you're putting down. If you're putting down less than 10%, you're probably going to be capped at a 3% seller concession. If you're putting 10 to 20% down, you might be able to get up to 6%. If you're putting large down payments, you can get up to 9% towards your closing costs. Again, the more you ask for, the less attractive your offer is going to be. So use this one with caution. Something I do with clients is we tend to offer more than the asking price, even if it's been on the market for a little bit of time. And in that way, the seller can still net the money that they need to or they want to, making your offer look more attractive. But we can ask for more seller help to get our overall cost to close down. So which option is best for you? Now, if you have lots of money in the bank and a decent credit score, a conventional 20% down is probably going to be your best bet. If you're someone who has a lower credit score and not as much cash to close, something like FHA could be a really great option. What I would advise is speak to a local real estate agent, because they may have connections with local lenders that may offer products like the 0% conventional with no mortgage insurance that I mentioned earlier. If you're thinking about buying a home in Lancaster or the surrounding area, please drop me a comment below or reach out to me on my website, as I'd love to help connect you with a lender and see what your purchasing power is, and potentially even help you find that next home.